time. You're welcome to go see it later, and you just need to coordinate with her schedule. And like I say, a reasonable time. So she's up there during some, I don't know exactly what her hours are, but they're like normal hours. So if you go up there, that's fine. I've told her that she doesn't need to feel the obligation to run in here at 8:30 at night specifically just to do that. So within, you know, like normal reasonable business hours, let's say, get with her. She'll be happy to share. Other questions? Other questions? Because I don't think I have any announcements for you. Okay. We're talking about preparing pro forma financial statements, but before we get into that, had kind of an interesting conversation with Tommy right before class, and I wanted to just so pause what we're doing here. I wanted to just kind of shoot something out at you because earlier in the semester I really harped on the definition of liquidity. Okay, we're going to get into investing in the third part of the course, so. I'm getting a little bit ahead of myself, but investing is what I'm most interested in anyhow. But he was telling me about this trade that he had on, and he was saying, yeah, I woke up this morning and there was no volume, there was no change, there was nothing going on, so I was wondering what was going on. So I decided not to say anything for a while, and correct me if I'm misrepresenting you here. And so I checked it, I guess, after lunch or something, and there was still no volume. So, you know, he's saying, hey, do you know what's going on? I don't keep track of every market out there, so I don't know what's going on. So it kind of intrigued me, and we pulled up a chart of it, TYD, right? Yeah. TYD. So the problem here is, okay, we've got this chart, which looks all well and good, but the problem is there's no trading going on in that market right now. Okay, so if he wants to get out of that market, what's the problem going to be?
You can't sell.
Yeah, well, assuming he's long, okay, then there's probably, if he tries to sell it, there's going to be no one there to buy it because there's no trading going on. So if he really wants to sell it, which is what's going to happen if he puts in a market order, what are they going to have to do to sell it?
Drop the price.
Drop the price. Now, eventually someone will step in and buy it. But because of that lack of liquidity, he may take a big hit on the drop of that price. Okay? So, and like I said, this is something we were talking about all of this before class, and I got his permission to talk about this as well. So, if any of you come to me with questions or anything you want to discuss, I'm not going to go share it with the class without asking your permission first. But the reason I'm taking a couple minutes to talk about this is because I think that this is a topic that's important for senior finance majors to be aware of. Okay, and as a senior level class, you know, we can vary from the program a little bit for important topics. And in my opinion, this is a very important topic for investing. And if you really wanted to tie it to corporates, then it would be an important topic for corporations as well if you're trying to raise money. But in any case, we look at this chart, and outside of that dramatic drop-off over there, it doesn't really, you know, well, whatever. You know, it doesn't really jump out at me. However, this is a line chart. If you drop over to a bar chart, look at all these gaps. All these gaps, all these horizontal lines are days of no trading. Okay? This is a classic chart of a market that is not very liquid, which means a market that is more risky. As opposed to, I mean, you guys have all seen charts of, you know, Microsoft and highly traded instruments. Well, this is a classic chart of a very illiquid market. So when you jump into something like this, be careful. Right? You drop down to today, and this is what he was complaining about before class. There's nothing going on. So if you look over the last 5 days, so basically the last week, I mean, that's ugly. Okay, so be careful about jumping into these types of markets. I mean, look at the gap right here. From 38 down to, what is that, 36? A $2 drop on a $38 price. What's that, 2.5%, 3%, something like that? And even on a monthly, Okay, so this is a monthly, and even on the monthly, look at what we've got going on here. Look at close here, open there. I mean, we've got stuff going on all over the place. So this is, my point with this is exactly why I harped on the definition of liquidity like I did. Okay, this is exactly why, to be aware of that when you jump into markets. I don't know how much that helped you out, but like I said, we did all this before class. But this is exactly why I harped on the definition of liquidity. Okay? Anybody want to offer Tommy a bit of advice?
Some condolences or something?
Sell it to your friend.
Already tried that, he ain't buying it.
Sell it to your future ex-friend.
Yeah.
Okay. Again, pay attention to liquidity. All right. Back on track here. What we're talking about is really one of my favorite topics in finance, which is forecasting. Yesterday we were going through the pro forma statements. Again, the point of that was to try and project our future financing needs, our deficit financing needs, or surplus, as the case may be, which is a capital structure decision. Okay, so that was the point of that. One of the assumptions underlying this, excuse me, that I don't think we really talked about too much yesterday, is the assumption that that assets, or at least some assets, are going to vary with sales. Okay? Does that make sense to you?
Yes.
Okay. So yesterday we talked specifically about receivables, inventory, and especially payables, other current liabilities as well, but particularly accounts payable. Does it make sense to you that those would vary with sales?
Yes.
As sales go up, we would expect all of those to go up, and vice versa. That makes sense?
Yes.
Okay. All right, seriously?
Yeah.
Okay.
Seriously.
No, that's an important assumption underlying this. Okay? And what I did mention yesterday was just the simple case of where if sales are going up, you're having more demand, then your inventory would probably go up because you're having to buy more to meet demand. Receivables would go up because you probably have higher credit sales, et cetera, et cetera. Okay? So what we're doing, assets can't grow at an unlimited rate without consequences. Okay? So if they grow at a certain rate, then we're going to have to finance that increase. Okay? If both receivables and inventory are going up, well, receivables are going up, which is good, but we haven't gotten that money yet. Inventory is going up, and we need to pay for that. Okay? Which means we're going to have to increase liabilities. All right? So that's the whole point of all this. All right? What we did yesterday, which was the books method, was a relatively short-term method where we would clearly have variable costs and fixed costs. All right, so as far as I'm concerned, we're basically looking like a year with this. Okay? Well, in the supplemental information that I gave you, I don't know if you've run across this in other finance classes, maybe you have, maybe you haven't, but what I wanted to do was introduce you to the concepts of internal growth rate and sustainable growth rate. Okay? And these are long-term concepts. Okay? These are long-term concepts. Because what we're doing is we're assuming that all costs are variable, and we're assuming that all assets are going to vary with sales. Okay, and you'll see that on my spreadsheet. All costs are variable, and all assets are going to vary with sales. Which, in the short run, like we've already talked about, in the short run, we could take issue with that. But in the long run, it certainly makes sense. Okay, we've already talked about that. What is the internal growth rate? Okay, you guys have printed this and prepared for class. So what is the internal growth rate? Okay, we're getting ready to calculate the internal growth rate. Well, who cares? Who cares about that calculation? I'm not asking if you care. I'm saying why bother? What's this tell us? All right, what the internal growth rate is telling us is the rate that we can grow in terms of sales, the rate that we can grow without any external financing of any kind. Okay, so this is the maximum sales rate at which we can grow without worrying about having to hit the capital markets to raise money. Okay. Does that make sense? You with me? Okay. And it is calculated, as you see from the handouts there, as ROA times this, which is our plowback ratio. Is the plowback ratio. I think that's how they, isn't that how they wrote it? Yeah. Okay, so the ROA times the plowback ratio over 1 minus ROA times the plowback ratio. Yeah.
What is
Phil.
the plowback rate?
Okay, what is the plowback ratio?
What is it?
What's the payout ratio? Okay, thank you for asking that question. The payout ratio is the percentage of payout ratio is the percentage of your net income that you pay out as a dividend. Okay, so we're talking about dividend policy here. So the payout ratio is the percentage of net income that's paid out as a dividend. For example, your company's policy is to pay 60% of net income as a dividend. Okay, so just as an example. Okay. That would be called your payout ratio. The plowback ratio is 1 minus this. Because this is what you're plowing back into the company. This is what you're reinvesting into the company. Which, of course, is going to be 1 minus your payout. Okay. So if your payout ratio is 60%, then, of course, your plowback ratio would be 40%. Thank you for asking that question. We good now? Okay. All right, so to calculate our internal growth rate, okay, which is the maximum rate we can enjoy, the maximum sales rate that we can enjoy without having to seek external financing of any kind. In other words, we don't have to borrow and we don't have to issue stock. To calculate that rate, ROA times the plowback ratio over 1 minus ROA times the plowback. So far, so good? Okay. What I have on the spreadsheet here, this big spreadsheet, which follows what we did yesterday, is proof of this calculation right here. Okay? So this is the same, this is still Elvis, so I'm springing off of the numbers that we were working with yesterday from the example yesterday. All right, again, the assumptions of this are right down here. Okay, so we're assuming that all assets are a percentage of sales. In other words, assets are directly proportional to changes in sales. They're variable. And all costs are variable. Again, probably not realistic in the short term, but definitely realistic in the long term. So what we did yesterday was a short-term approach. This is a long-term view, a long-term approach. Okay? So, starting over here at the income statement, what I've got is we're just, I left 2008 on there, but we're ignoring 2008. Okay? So the first thing that I did was calculate the percentages of last year. Close enough. Right? So again, we're assuming that all costs are variable, which is to say that they're all a percentage of sales. So all I'm doing here is taking each cost divided by sales. And there you go. Okay, so that's what's in the yellow column right there. So far, so good? Okay. Same conversation with assets. Okay, so with the yellow column here, doing the same thing. So all of these are each asset for 2009 divided by the sales for 2009. Okay. All costs variable, all assets variable, including cash. All right. So far, so good? Okay, and the point, again, is to forecast our deficit financing needs. So, similar to what we did yesterday, what we're going to do here is leave everything alone with the exception of retained earnings. Okay, so we'll go ahead and forecast retained earnings. I probably should put that in yellow to be consistent. But what we're trying to do is project what we're going to need to do here, which includes payables and other current liabilities. Okay. Best practices of spreadsheet, final exam review from chapter 1. I have the calculations that I'm doing right in this area here, and then of course the output right here. So what I have in this example, the facts in the case told you that they paid $22,000 in dividends for the year, right? Well, their net income was $44,220. They paid out $22,000. So what we're going to assume is that their dividend policy is to pay out 49.75% of their earnings. Okay? And that is the payout ratio right there. With me? Make sense?
Repeat that,
Okay.
please.
I'm sorry?
Could you repeat that one more time?
Yeah, in the facts of the case, which actually you would know from corporate policy in the real world, is that that last year they paid out $22,000 in dividends. Okay? Their net income last year was $44,220. So 22 divided by 44 is 49.75%. So we're assuming that's what their dividend policy is. Again, we're looking at the long term. So the long-term view of this would be that's what their average dividend policy is going to be. They're going to pay roughly 50% of their net income out as a dividend, okay? Which is consistent with what we were talking about with Tony yesterday, with companies increasing their dividends. That's what they try and do. Well, what else do they try and do? Increase their net income. In other words, their earnings per share. Okay, so that correlates. Okay. So we're okay on payout ratio? All right, and below that is the plowback ratio, which is simply 1 minus the payout ratio.
What's the symbol for the plowback ratio? I can't see.
They're using a B.
Okay.
That's a B. Okay. So far, so good? Mm-hmm. Okay. All right, next is ROA, which you already know that ratio. That was one of the ones you had to memorize. Final exam review, how do you calculate ROA?
Net income
Net
divided.
income divided by assets, which is what I have here. And while we're on the subject, even though we're not quite there yet, below it I have ROE, which is net income divided by equity. Okay, so the internal growth rate of this company is, what did I do with it? internal growth rate of this, ROA is 0.0268. I'm sure that's a rounded number. The plowback is
50%.
0.5025.
Mm-hmm.
Everybody with me?
Yes.
Okay. And then, of course, we'll divide that by 1 minus that stuff. So 1 minus the numerator, which is what I have right there. Sir?
Is there a reason that we went out so far on the decimals? Yeah, like,
No.
is that, okay.
That's one of the nice things about taking the exam on Excel is that however many decimals I have in the answer, you can just easily adjust the column to that. There's no doubt about it here.
So what is 1.36 is telling us?
Okay, what is that? Well, that was what I was getting ready to say. Exam question, what is 1.36 telling us? Exam question, Elvis Company has an internal growth rate of 1.36%. That means A, B, C, D, none of the above. E, not enough information to answer the question. F, I have no idea. I put F in there sometimes. And I do that to make you guys laugh and relieve the stress. What does 1.36 tell us?
The company can grow its sales at 1.36% without having to finance it.
Yeah, exactly. Said another way, the maximum sales rate that we can enjoy without worrying about external financing of any kind is 1.36%. Okay, that's what this is telling us, and that's what this spreadsheet is proving, because what I have in here is an input box right there for sales growth. And I'm doing it on assets over here, which is just pulling from that. But this is an input box. This is how you test your model. Okay, this is one of your best practices is test your model thoroughly, which is a big no-brainer. Okay, but how do you do that? Well, this is the way that I'm testing this model. Right. So with a sales growth of 1%, now all of my cells in gray are keying off of these calculations. All right, so for example, sales last year, okay, and then 1 plus our growth rate gives us sales this year. I can easily copy that all the way down. And there is our forecasted income statement.
So that is using 100% of your plowback and not adding anything to your return earnings if you go with that number, that 1.3.
No, that's not true.
No.
That's not true. Because over here, all right, we're going to do the same thing. All right, so K5, right? Yeah, it's sales. And actually, I can probably do it this way. Yeah, something's not working there. But answering your question is, and this is why I really should, in the original example, I should have shaded this in yellow. So this is where we take into account the dividends. Okay? So what we're saying here is that all costs are variable. So if sales go up by 1%, then all costs and everything go up by 1%, which gives us a forecasted net income of $44,662. But we're still assuming that we're going to pay out 49.75%, I believe it was.
Yes.
Pay out for. So that means, and that's what I have in this calculation right here, is that now our dividends are going to increase from 22,000 to 22,220.
Oh, I see.
Okay? So over here, our cash is 1% of sales.
Mm-hmm.
Okay, so 1% times our new sales should get us there. Okay, so we project all of our assets down the same way. And that's what we have over here. Okay, so these are our projected assets. We're trying to forecast all of this right here, but retained earnings is still going to be our beginning retained earnings plus the forecasted net income minus the forecasted dividends. Okay, so that's where we take it into account right there. Like I said, I should have shaded that in yellow from the beginning. Okay. Other questions? Okay. Okay, so at a sales growth rate of 1%, you can see that liabilities and equity are greater than the projected assets. So we have a surplus, okay? Recall my if statement that I showed you guys yesterday. You want, does everybody understand that if statement with the quotes?
Mm.
Do you want me to show you that?
Yeah, can you show? I understand. I don't know
Yeah.
how you bring it up.
Okay, so, let's say B26. Okay, so with this cell right here, all I'm doing is taking the difference between the assets and liabilities. Okay, don't ask me why I put a negative first. I don't remember why I did that. Okay, but that cell is simply the difference between assets and liabilities. So in this case, the liabilities exceed the assets.
Put a negative first, but you added B12 instead of subtracting out.
Right. Okay.
So
Okay.
you just take your bottom line minus
Yeah.
your total assets instead of doing the other.
You can do it that way as well. Okay, so if this is a negative number, then it's a surplus. All right? So what I have in this cell right here is if that is less than 0,
Mm-hmm.
and the key, with the if statement, okay, you put in a condition, and then two commas, excuse me. So what you're saying is, if this condition is met, then do this. If it's not met, then do that. So if the condition is met, then you do what's behind the first comma. If it's not, then you do what's behind the second comma. With me?
Don't you put a
What's that?
quote?
I'm sorry?
Don't you put a
Well,
quote?
yeah, I'm getting to that.
Yeah.
But I mean, that's the basics, because it doesn't have to be quotes, it can be calculated.
Okay.
Okay. But that's the basic of the formula, which is what they're showing you right here. It's
Okay.
just another way of saying, if this is true, then do this. If it's false, do that. Okay. So in this case, I'm saying if it's less than 0, then we have a surplus. So I want to display the word surplus. So whatever text it is you want to put in there, put in quotes. Okay, so you can put whatever you want in here, you just got to put it in quotes. Okay? And if not, then what I want to do is I want to say deficit But in this particular case, there's a third possibility, and that is that it could be zero. In which case, if it was zero, I would have an error. And that's why I have what they call nested if statements. So what I did was, if that's true, then put in surplus. If it's not, then I'll put in a second if statement, which is if B26 is greater than zero, then put in deficit, and then if not, put in balanced. And you got to be careful because you got to get the number of parentheses correct. That's why on these, I told you this once before, I don't remember what we were talking about, but on nested statements like this, at each step, I hit enter to make sure I got that step right. And then I pull up with F2, I pull up with formula and enter the next section, so that way if you mess something up, then you don't have to start all over again. Okay. And of course, so if we've got negative, we're getting surplus, positive, we're getting deficit, zero, we're getting balanced. Questions about that? Yeah.
So you always take the total liabilities minus the total assets?
For purposes of what we're doing, yeah. I don't like words like always and never. But in this case, yeah, because what we're trying to project is the deficit financing or the surplus financing. And in this case, at a growth rate of 1%, we would have a surplus. Which means, well, what are we going to do with that excess cash? Okay? Which is a capital structure decision. We're going to pay off debt with it. We're going to buy back some stock with it. We're going to go have a party in Costa Rica with it.
But I think what's throwing me off is the negative, the actual negative in front of it makes me want to think that we don't have that money and we need financing. When we really do. Like, see, the surplus means we have $5,000 extra, right?
Well, yeah, I mean, if you really wanted to flip it around and make it a positive, then you could do it that way. I'm not going to get on the exam and say, what does negative 5934 mean?
Right.
A, surplus, B, deficit, C, balanced. I'm not going to do that.
Okay. You just want to know, to make sure that we know we have more assets than liabilities, we got a surplus.
Yeah, and, well, actually it's the opposite, but yeah. And you have more liabilities than assets.
Assets, yeah.
That's a surplus, yeah. That's the point of this. Okay. All right, other questions so far? Other questions? Okay. All right, so now that we